Matthew Johnson is with us, President, Owner, Johnson Wealth and Income Management. Matthew, thanks for being with us. So we're watching all things inflationary. Obviously, we got in that jobs report. We saw wages on the rise. We've seen prices paid higher. We're waiting on a CPI print, which could be the highest since 1982. In your mind, is inflation still very much alive? It hasn't dissipated yet.
Absolutely. Inflation is definitely going to be a part of our life for some time. It's not as transitory as what I think many people would like it to be. And, you know, as the Federal Reserve comes and they're giving us these proclamations that they're going to try to thread this very fine, tiny needle, on one hand, they don't necessarily want to see another taper tantrum like we saw back in 2018, but at the same time, they've got a job to do, and that's to try to be able to keep this inflation in check. And when we look at the economy, I believe the economy is still going to continue to experience growing pains. There's the supply shortage, and until that really gets resolved, we're going to continue to see more and more prices increasingly, ever so incrementally, as this progresses.
So you think that Powell will continue to translate to us very clearly what he plans on doing because he doesn't want to spook the markets?
Well, I believe that every time they come out and they say we're going to plan on raising interest rates, whether it's 2 times or 4 times or 7 times, as they've said in the past, these are like little weather balloons, right? They're sending out these balloons to get feedback. And we've got to go back to 2018 and understand that, you know, the stock market continued to raise even through the first 3 quarters and the first 3 rate increases. So we can anticipate that even if we get rate increases, there's still going to be a growing market. However, on the last quarterly increase, that's when the market said, nope, don't think so. And we saw a pretty sharp decline in the stock market in the end of 2018. So moving forward, I think we're still going to continue to see market growth, but it is going to be choppy. It kind of reminds me of that song by Blood, Sweat, and Tears, Spinning Wheel, right? It's the up, it's the down, it's the round and around. And we've got to be able to anticipate some of that and think about where we have our money and what we're doing with our money to be defensive if something like a taper tantrum actually occurred.
And as the jobs picture continues, you know, the latest jobs report we got obviously wowed Wall Street, and you had the revision of the prior 2 months with another 709,000 added or put back, however you want to say it. But the point is that the jobs picture seems to be on the right track, right? And that's part of it too.
Absolutely. I think that some of the things that we've seen as a result of COVID-19 and the shutdown of the economy has really forced and revealed maybe a bit of a blind spot. You know, economies that are going to continue to grow have to invest in technology. They have to invest in skilled labor. They have to continue to invest in that infrastructure. And when all of a sudden you have a black swan event like COVID-19, it can really test the mettle of everything. It can test all the different areas. I see even in my area in the Midwest, we still have plenty of jobs that are available. They're getting better. But I think employers are going to have to continue to create greater incentives to bring people back into the market. I think that the jobs that might have been hired at the end of last year, maybe those employers have kept these people on because of a shortage of skilled labor, and they're just having to train them internally. But it's all a part of the puzzle. It's a little piece, and it's an important piece.
How do you figure out the buying opportunities now then?
Well, I'm more of an income guy, and so I'm watching the interest rates with expectation that we're going to get some really good buying opportunities, especially within the bond and the preferred market. You know, as we think about what happens to interest rates as they go up, we tend to see fixed income go down. We've already seen the 10-year Treasury raise. Is it going to get up to, you know, the 3.2 level of 2018? I don't know. That's a pretty steep climb of around 68%. But as good quality fixed income starts to respond and already is responding in anticipation of what the Federal Reserve is likely to do, man, it's a great defensive play. We spend less, we get more yield, and income is something that we all need and want in retirement. So I think it's a great buying opportunity.
And then, you know, when you see the rates, right? So today I saw it at 1.92 or something like that. I mean, you're still seeing the highest levels in some time. Do you expect rates to continue to rise? And to what levels?
I do expect interest rates to continue to rise. In that regard, the yields, we've got to be mindful though that we've got a lot more debt today than we did in 2018 though. And I think that that's going to mitigate maybe some of that rise in the yield that we see. So is it going to go up? Yes. How much? Is it going to get to 3.2%? I have no idea. I don't think that it's going to steam ahead as quickly as it did in 2018, but I do believe that as they continue to provide us with these proclamations of rising interest rates, we're going to continue to see that bond yield go up.
You use the phrase carefully thread the needle, and at this point now, right, there's been talk of 3 to 7 hikes. There's been talk of 25 basis points to 50 basis points. I mean, we could, if the Fed doesn't make these moves correctly, it really could put us backwards. I won't say into recession, but it really could slow things down, right?
Absolutely. And I believe the bigger issue for the Feds right now is they would much prefer to keep the economy happy than to keep the stock market happy. So it is a very tight rope, right? On one hand, they can have a taper tantrum where the market really responds negatively and starts to shed points, but on the flip side of the coin, they raise it too high, too fast, too quickly, and all of a sudden they throw us back into a recession. So I believe that Jerome Powell and the Feds in general they're doing an excellent job. They're trying to be very pragmatic about this. They're sending out these test balloons. They're getting a lot of feedback from a lot of different sources, which is helpful to them.
Right.
But I think we need to be able to anticipate that it could go either way. And as long as we're continuing to, be the good steward of our money and invest properly for both outcomes, I think that that's the best we can do.
Right. Matthew Johnson, thank you so much. President, owner of Johnson Wealth and Income Management. Nice to see you. A good discussion, too. Thank you very much.